Who has not heard of Warren Buffett, who is considered to be one of the richest persons in the world? He is well known for his success in business as well as his generosity toward charitable causes. Nothing out of the ordinary is required of you if you wish to be as successful an investor as Warren Buffett. Buffett makes investments in outstanding companies that are now selling for prices that are lower than what they are truly worth. He then retains his assets for as long as the companies continue to be great. The investment theory of Warren Buffett. Buffett subscribes to the value investing philosophy espoused by Benjamin Graham. Value investors are interested in buying shares that are selling at prices that cannot be rationalized based on the intrinsic value of the company. Analysis of a company's fundamentals is the method that is used to assess the intrinsic value the vast majority of the time, although there is no one method that is universally acknowledged for calculating intrinsic value. The value investor seeks out stocks that he or she believes are undervalued by the market or stocks that are valuable but not recognized by the majority of other buyers. Value investors are similar to bargain hunters in this regard. The value investing strategy is taken to a whole new level by Warren Buffett. A significant number of value investors disagree with the idea that the market is always efficient. According to this hypothesis, stock prices are always equal to their intrinsic value. Because of this, it is more difficult for investors to make profitable trades with stocks that are either undervalued or priced too high. They do believe that the market will, at some point in the future, begin to reward high-quality stocks that were, for a period of time, trading at a discount. When it comes to achieving success in life, Warren Buffett has often emphasized the need of making personal investments. This includes making wise decisions regarding your finances as well as enhancing your understanding of the fields in which you intend to participate. Buffett, on the other hand, is not bothered by the complexities of the stock market's supply and demand relationships. In point of fact, he is not much bothered by the goings-on of the stock market at all. Buffett's strategies. Company performance. The stockholder's return on investment is another name for the return on equity, which can be used interchangeably. It displays the rate at which shareholders generate income from their shares in the company. When analyzing a company, Buffett always looks at its return on equity to determine whether or not it has consistently performed well in comparison to other businesses operating in the same industry. It is determined by taking the net income and dividing it by the shareholders' equity. It is not sufficient to only consider the ROE in the most recent year. In order to do a proper historical performance analysis, the investor needs to look at the ROE over the last 5 to 10 years. Company debt. Another important factor that Buffett pays close attention to is the ratio of debt to equity in a company. Buffett desires to see a relatively low level of debt so that the majority of a company's earnings growth can come from the equity of its owners, rather than from money that has been borrowed. The DE ratio can be determined by the following formula: the total liabilities divided by the equity held by shareholders. This ratio illustrates the proportion of equity and debt utilized by the company in the financing of its assets. The higher the ratio, the greater the amount of debt utilized in the financing of the company as opposed to equity. Earnings can be more erratic, and big interest payments can be incurred if the debt level is high in comparison to the equity. In order to conduct a more stringent analysis, investors may oftentimes use solely long-term debt rather than total liabilities in the figure presented above. The margin of profit. The profitability of a business is not only dependent on having a healthy profit margin, but also on steadily expanding that margin over time. The formula for determining this margin is to divide the net income by the net sales. At a minimum of 5 years into the past, investors should look in order to get a fair idea of historical profit margins. When compared to a decreasing profit margin, a high profit margin shows that the company is performing well in its business operations, while an increasing profit margin suggests that management has been exceptionally efficient and has been successful in limiting expenses. Is the company available to the public? In general, Buffett will not consider investing in a company unless it has been in business for at least 10 years. As a consequence of this, the vast majority of technology businesses that have made their debut on the stock market within the last 10 years will not register on Buffett's radar. He has stated that he is not familiar with the inner workings of many of today's technological companies, and that he will only invest in a company that he has a comprehensive understanding of. Finding businesses that have stood the test of time but are currently selling at a discount in order to make value investments is essential. Contrary to technical investing, which looks at a stock's price and volume in addition to how the price has changed in the past, value investing concentrates on a company's financials. Value investing is contrasted with technical investment. Under no circumstances can you discount the importance of past results. This demonstrates that the company is capable of increasing the value it provides to shareholders. However, it is important to keep in mind that the performance of a stock in the past does not guarantee its performance in the future. The role of the value investor is to forecast how well a company will do in the future and invest its money accordingly. Finding out this information is naturally difficult, but it is clear that Buffett is quite skilled in doing so. Commodity reliance. It's possible that your first reaction to this inquiry will be to consider an extreme method for vetting a company. Buffett, on the other hand, thinks that this question is quite significant. In general, he avoids investing in businesses that produce goods that are indistinguishable from those offered by rivals, as well as enterprises that are wholly dependent on a single commodity, such as oil and gas. If the company does not offer anything that is distinguishable from other companies operating in the same field, Buffett does not see much that makes the company stand out from the competition. What Warren Buffett refers to as a company's economic moat or competitive advantage can be seen as any quality that is difficult to imitate. The greater the width of the moat, the more difficult it is for a challenger to take market share away from the incumbent. Is it cheap? This is the most important part. The most challenging aspect of value investing is figuring out whether or not a company is cheap. It is easier to find companies that fit the other 5 criteria and check them off the list, and it is the ability that Buffett values the most. In order to verify this, an investor needs to estimate the intrinsic value of a firm by conducting an analysis of a number of business metrics, such as the company's earnings, revenues, and assets. And a firm's intrinsic value is typically larger than its liquidation value, which is the value that a company would have if it were to be dismantled and sold off at this time. After Buffett has established the company's complete intrinsic value, he compares that value to the company's current market capitalization, which can be thought of as the present total worth or price. It really is that simple, isn't it? However, the key to Buffett's success is his unparalleled ability to precisely determine an asset's inherent value. Although we are able to explain some of his criteria, there is no way for us to know exactly how he became so precise in his mastery of the art of determining value. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.